why it reminds me of the fourth quarter of 2007 is because a lot of the forecasts that I have been making since pretty much the beginning of QE and 0% interest rates was that eventually rates would move up and it would be a huge problem for everybody who had loaned money, the banks, and then the U.S. government, of course, would be in a lot of trouble because it borrowed so much money and now had to deal with rising rates.
Peter Schiff discusses his predictions about the current economic situation, drawing parallels between the events leading up to the 2008 financial crisis and the present. He highlights his earlier warnings about the mortgage market in 2007 and the subsequent recession, emphasizing that similar risks are currently being ignored by the mainstream. Schiff predicts that rising interest rates will pose a significant problem for those who have borrowed money, including banks and the U.S. government. He draws attention to the potential underreporting of economic data, reminiscent of the rosy economic numbers reported in the fourth quarter of 2007, just before the Great Recession. Schiff expresses concern that a year from now, we may discover that the economy and labor markets are not as robust as they seem. The recent job report for October is discussed, with Schiff pointing out downward revisions to prior months, a loss of manufacturing jobs, and an increase in the unemployment rate. He criticizes the creation of government jobs and part-time positions, emphasizing the need for productive, higher-paying jobs. Schiff also notes the record high number of Americans holding multiple jobs, attributing it to the rising cost of living. In summary, Peter Schiff contends that the economy is not as strong as reported, warning of a looming recession and expressing dissatisfaction with the current state of job creation and economic indicators. Here's the clip. Also, make sure to hit the like button, subscribe, and drop your comments below.
2007, a lot of things happened in the mortgage market, particularly in subprime, that I had been predicting would happen for years. And I had been predicting that that would be the trigger of a much broader financial crisis. And so in 2007, I saw the evidence that my forecast was correct. And I became more emboldened in my predictions of this crisis. But the mainstream was very dismissive of what I was saying. Even up till the summer of 2008, we were right around the corner from this global financial crisis. And we were in the middle of what became known as the Great Recession, the worst recession since the Depression. But even up till the summer of '08, people were denying that a recession was anywhere in sight, let alone that we were in one. And why it reminds me now, this is the fourth quarter of 2023, why it reminds me of the fourth quarter of 2007 is because a lot of the forecasts that I have been making since pretty much the beginning of QE and 0% interest rates was that eventually rates would move up and it would be a huge problem for everybody who had loaned money, the banks, and then the U.S. government, of course, would be in a lot of trouble because it borrowed so much money and now had to deal with rising rates. So a lot of the predictions that I've been making are coming true, yet once again, the mainstream is oblivious to these risks, just like they were oblivious in '07. And I also think it's significant because in the fourth quarter of 2007, that's when the Great Recession began. But during the fourth quarter of 2007, we were reporting rosy economic numbers, just like we are reporting now. It wasn't until the fourth quarter of 2008, a year later, that they went back and they revised down an entire year's worth of economic data. Right. And all of a sudden, those rosy statistics became the Great Recession. And I have a feeling that a year from now, we're going to find out that the economy wasn't nearly as good, in particular the labor markets, as we were being told. And I think that Joe Biden's horrific approval ratings, he's the lowest or the least popular president since Jimmy Carter at this point in his first term. There's a reason for his lack of popularity, and it's because the economy is lousy. The numbers are not capturing how bad things are. And first of all, a lot of the numbers are just guesses anyway, and they're very subjective and they're very biased in what they want to report. But look, we got the jobs report that came out today for October. Lots of revisions, all downward to prior months. But the numbers we got today were horrible. in that only 99,000 private sector jobs were created. 51,000 government jobs were created. I mean, we don't want those government jobs. I mean, they're not productive, and they run up the deficit because we have to pay for them, and the government doesn't have the money. We lost 35,000 manufacturing jobs. Those are the jobs we want. Those are the ones that we lost. Those are productive, higher-paying jobs. But also, the unemployment rate went up. The labor force participation rate went down. And in fact, if you look at the household survey, I think 400,000 people lost their jobs. And the 99,000 jobs that were created by the private sector, that was well below estimates, they were all part-time jobs. And they went to people who already had a job, or two or three. The number of Americans holding down multiple jobs just hit another all-time record high. People don't want two or three jobs. They want one job. But the problem is one job won't cut it anymore because food is so expensive. Rent is so high. Insurance, medical care, taxes, everything is going up except people's paychecks. I mean, maybe they're going up a little bit, but they're not going up enough. And that's why they now need two or three paychecks to do the job of one.
In this next segment, Peter Schiff questions the widely held belief that a weakening economy should naturally lead to lower inflation, unraveling Keynesian principles along the way. In his contrarian perspective, Schiff contends that a robust economy doesn't always translate to inflation. He argues that inflation is intricately tied to government actions, like deficit spending and Federal Reserve policies. Schiff suggests that a strong economy can act as a shield against inflation by fostering the production of more goods and services for circulating money. The intrigue deepens as Schiff scrutinizes the recent job market, expressing concerns about non-productive roles funded by the government potentially steering us towards larger deficits. Brace yourself for Schiff's prediction that as the economy weakens, deficits could surge, possibly doubling to a staggering $4 trillion, unleashing a wave of inflation. The complex dance between the dollar's strength and inflation adds another layer to Schiff's analysis, warning of a potential dollar decline that might trigger a resurgence of inflation.
Well, I mean, it's going to be reflected in the markets, but I think the traders have got it wrong. They believe that a weakening economy means a weaker inflation, that if we have more people unemployed or not as strong an economy, that we're going to have a reduction in inflation. And they've got that wrong. And that's because they have this Keynesian belief that inflation is a byproduct of economic growth, that a strong economy creates inflation. And that's not true. Actually, a strong economy helps counteract the inflation that the government creates. The government, the Federal Reserve, and deficit spending is the source of the inflation. Now, sometimes the inflation can be masked by a strong economy, which is productive and turning out more goods and services for that money to buy. But like the jobs numbers that we just got are highly inflationary. The markets don't get that because we lost productive jobs. We gained non-productive jobs paid for by the government, which means bigger deficits. As the economy falls into an official recession, the deficits that are already horrific, that are over $2 trillion a year, are going to probably double to $4 trillion or more. And that is inflationary because the Fed is going to be printing money to monetize all that debt. The weaker economy is actually going to send inflation higher. And in fact, the main reason that inflation came down, as measured by the CPI, from 9% to about 3%, and now it's already trending back up, it wasn't because of the rate hikes. It was because the rate hikes caused the dollar to go up. And it was the strong dollar that brought down oil prices, other commodity prices, and helped bring the CPI down. But I think the dollar has topped, and I think it's about to surrender all of those gains. And in fact, if you look at what happened this past week, it was a significant, I think, reversal, outside reversal, where the dollar index took out the high from the previous week, yet closed significantly below the low from that prior week. And I think the dollar is about to drop. And so if the dollar has put in a top, that means inflation has put in a bottom. And that's going to be a very difficult predicament for the Fed because just as the economy is weakening, inflation is going to be strengthening. What do they do?
As we conclude our exploration with Peter Schiff, the parallels between the 2007 mortgage crisis and today's economic landscape are striking. Schiff's foresight, dating back to the QE and 0% interest rates era, is now materializing with the looming threat of rising interest rates, affecting everyone from individuals to banks and the U.S. government. This forecast is part of a broader narrative echoing warnings of an impending recession, reminiscent of the denial preceding the Great Recession. The recent jobs report vividly illustrates the economic challenges: surging non-productive government jobs, dwindling manufacturing positions, and an increasing reliance on multiple jobs due to soaring living costs. Adding another layer of complexity, Schiff challenges the conventional belief that a weakening economy should naturally lead to lower inflation. In this paradoxical dance, a weaker economy might, in fact, fuel higher inflation, presenting a complex scenario for the Federal Reserve. If these economic revelations resonate, engage by liking, sharing, and subscribing for more enlightening discussions.